You paid more for the same car because your credit score was 27 points lower. Same you, higher price. Make it make sense? Credit scores control where you live, the car you drive, and sometimes whether an employer even calls you back. That's wild because nobody actually teaches you how this number is made. Real talk, the system is not perfect, and parts of it are unfair. But if you understand how the score works, you can make it work for you, not against you. In the next few minutes, I'll explain what a credit score is, how it's calculated, what actually moves it up or down, and the exact steps to improve your score without the usual confusing jargon. A credit score is a 3-digit number, usually between 300 and 850, that predicts how likely you are to pay bills on time. That's it. It exists because lenders want a fast way to judge risk. They don't know you, so they use your past borrowing behavior as a shortcut. Is that perfect? But it's the game we're forced to play. Big misconception. Checking my score hurts my score. Not true for soft checks like Credit Karma or your bank app. Only hard inquiries from actual applications can nudge your score down a bit. Think of your score like a reputation score in a game. Complete quests, pay on time, and don't overload your inventory. Don't max out cards, and your reputation climbs. Miss a big quest, pay late, and the score drops fast and takes time to repair. Here's how this actually works, broken into 5 parts most lenders care about. Payment history, about 35%. Do you pay on time? One late payment, 30 plus days past due, can drop your score by 60 to 110 points. It can stick around for up to 7 years, but the impact fades as it gets older. Credit utilization, about 30%. That's how much of your available credit you're using on revolving accounts like credit cards. If you have a $1,000 limit and you're carrying $400, your utilization is 40%. The goal? Keep it under 30%, and under 10% is even better for top scores. It's measured at statement close, not the day you pay. So even if you pay in full monthly, a high balance that gets reported can still spike your utilization. Length of credit history, about 15%. That's the age of your accounts. Oldest, newest, and average. Longer is better. Don't close your oldest card unless it's costing you real money. Its age is helping your score. New credit, about 10%. That's how many times you've applied recently. A single hard pull might drop you 5 to 10 points for up to a year. Multiple in a short window looks riskier. Rate shopping for a car or mortgage within a short window often counts as one event. Credit mix, about 10%. Variety helps. Credit cards, installment loans like auto or student, maybe a mortgage. You don't need everything, but a healthy mix shows you can handle different types. Let's do realistic math. Say you earn $40,000 a year, pay $1,400 rent, and use one card with a $1,500 limit. You put $600 on it monthly to earn points, then pay it off. At statement close, $600 reports on $1,500, so utilization is 40%. That's dragging your score. 2 fixes. Pay $500 before the statement closes, so only $100 reports, around 7% utilization. Or ask for a limit increase to $3,000, so $600 becomes 20%. Utilization is like how full your backpack looks to the teacher. Even if you can carry it, if it's stuffed, they think you're overloaded. A lighter looking backpack equals less risk. Meet Jordan, age 24. Income $45,000. Rent $1,250. Student loans $22,000 in good standing. One credit card, $1,200 limit. Jordan's score is 648. Okay, not great. Starting point, clean payments last 12 months. Utilization about 42%, $500 reporting on $1,200. Oldest account 2 years, average 1.5, 2 hard pulls in the last 6 months. Mix is card plus student loan. Here's the smart move Jordan makes. First, sets an automatic mid-cycle payment of $400, so only around $100 reports each month. Utilization drops to about 8%. Second, requests a credit limit increase after 3 on-time payments and gets bumped to $2,500. Third, uses Credit Karma and the Experian app to monitor reports and set late payment alerts. Fourth, adds a tiny recurring bill, like a $12 subscription, to keep activity without overspending. Fifth, turns on auto pay for the minimum so a due date can't sneak past, then pays the rest manually. After 1 month, the score bumps roughly 20 to 30 points from the utilization fix alone, around 670 to 678. After 3 months, the higher limit lands, utilization now around 4 to 5% most months, and the score creeps into the 690s. After 12 months, no lates, aging accounts, fewer recent pulls, the score crosses 700 to 715. After 24 months with perfect payments and more age, Jordan sits around 730 to 750, often the line between good and very good. What if Jordan did the common mistake? Max the card to $1,100 and pay it off after the statement closes each month. Utilization reports 92%. Score stays in the low 600s, higher interest on the car, maybe worse apartment options. Same spending, different timing, very different outcomes. Now, the catches, because there are always catches. Catch 1. One late payment hits hard. If you're 30 plus days late, the damage can be big and long-lasting. Turn on auto pay for at least the minimum on every account. Then pay extra manually. Catch 2. Closing accounts can backfire. You lose available limit, your utilization jumps, and your average age can drop. If a card has no annual fee, consider keeping it open and using it once a quarter. Catch 3. Not all scores are the same. You'll see FICO and Vantage Score, and even different versions for auto or mortgage. They're cousins, not twins. Expect differences. Focus on fundamentals. Pay on time. Keep utilization low. Build age. Catch 4. Medical collections and errors happen. Stuff hits reports incorrectly. Check your reports and dispute real errors. It's annoying, but when something is truly wrong, documentation helps you get it removed. Why does this matter? First, your score is a price tag. A lower score means a higher interest rate. On a $20,000 car, over 5 years, going from 8% to 5% saves over $1,700 in interest. That's real money. Second, access to housing and jobs. Many landlords check credit, and some employers do for certain roles. A few points can be the difference between approved and sorry third, breathing room for your future. A strong score means when you actually need to borrow, car dies, emergency move, you get fair rates, not predatory ones. In a world where wages haven't kept up with costs, this is one lever you control. Here are the moves you can make today. Step 1. See your real situation. 15 minutes. Use Credit Karma, Experian, or your bank's built-in credit tool. Look at your score and the items on your report. Turn on alerts for balance changes and due dates. Free apps often show Vantage Score, which is fine for tracking trends. Step 2. Fix utilization. This month, 10 minutes. Make a mid-cycle payment a few days before your statement closes, so LESS reports. Or request a credit limit increase with your current issuer. Many do soft pulls, but check first. If you're tempted to overspend, skip the limit increase and stick to mid-cycle payments. Target under 30% reported, under 10% if you can. Step 3. Bulletproof on-time payments. 5 minutes. Turn on autopay for minimums on every card and loan. Add a tiny recurring subscription to any idle card so it stays active. Use your bank's bill pay reminders. If cash flow is messy, pay 2 to 3 smaller times monthly instead of one big chunk. Step 4. Build credit if your file is thin. 20 minutes. Try a secured card from Discover, Capital One or Fidelity, or a credit builder loan with Self, or become an authorized user on a trusted family member's long, clean card, low utilization, and no lateness required. Pick one, use it lightly, and pay perfectly. Reality check. If money is tight and you're juggling bills, job one is avoiding late payments. Even paying the minimum on time protects your score better than paying a big chunk late. If you can't lower utilization right now, do a small mid-cycle payment. Even $50 helps the reported balance. Bottom line, your credit score is a reputation number that reacts to 5 things: payment history, utilization, length, new credit, and mix. Master on-time payments and keep reported balances low, and your score will climb over time. This won't solve every money problem. Housing and wages are still tough, no cap. But a stronger score lowers your costs and opens doors. Next up, how to build credit from scratch, secured cards, credit builder loans, and authorized user strategies, because that's where most people start. Tap that next. This is education, not financial advice. I'm not your financial advisor. Do your own research and make decisions based on your specific situation. Past performance doesn't guarantee future results. Investments can lose value.